One of the casualties of this very tight leashing of revenue expenditure has been the fact that you haven't made any increases to the transfers to the lower tiers of the income pyramid. So it's really a toss-up whether you wanted to sort of kind of go a little easy on the fiscal target and accommodate a couple of other things that would kind of help pump prime the economy. The markets were very concerned about consumption demand. There's been a lot of initiative on the supply side of the economy by the government. If you look at the global scenario today, you can't really expect much support from there. Rural consumption was doing badly, it started picking up. But the real problem is the deceleration in urban demand. I think it is really a response to an emerging problem of urban consumption, which has remained tepid, but which has become worse, due to a number of factors.
Hello, Abheek. Thank you for joining us today. I have very simple questions, and they have mostly got to do with the macroeconomic stability.
Right.
So my first question is, the government has kept an ambitious target of 4.4% of GDP as a fiscal deficit target. So
Right.
can you explain to us, break down the fiscal math, and then how the government is going to achieve these numbers?
Let me put it very broadly. So let me start with the GDP growth and nominal GDP growth assumption specifically. So it assumes a 10.1% nominal GDP growth. And then you start looking at revenue expenditures and tax collections and other revenue collections. With a 10.1% nominal GDP growth, tax collections grow at about 10.8%, which is kind of doable. Your revenue expenditures are kind of very, very tepid, 6.6%. They've kept a harness on that. Capital expenditure shows an increase of about 10% over last year's actual spending or the revised estimates. But if you take it relative to the budget estimates, it's pretty much flat. And there are a couple of supports that the government assumes. One is from dividends from PSUs and RBI. And the RBI dividends are likely to be large because, as you know, the RBI has been selling dollars and buying rupees. And, if since it has a rupee balance sheet, that results in a profit for it. So it's going to transfer that amount. So the amount set aside as dividends for the coming year is large. And otherwise, the math kind of makes sense. You could argue that 10.8% seems doable, but having given up revenue through the tax cuts, it is losing 1 lakh crores. So we're making an adjustment for that. The tax growth seems a little aggressive. They're banking a lot on corporate tax increases. So that's the little niggle that you might be concerned about. Otherwise, I don't think the math is unrealistic. So this is how you get to a 4.4% fiscal deficit target without making any kind of unrealistic, over-ambitious projections on any count.
The budget was expected to resort to some sort of pump priming. Actually, most of the economists did expect and kind of were hoping that there could be some version of pump priming, in the sense that there are issues with structural and cyclical headwinds to growth. So were you surprised that or let me rephrase it this way, that would the government measures be enough to boost demand and consumption and therefore lend some support to growth?
Look, we have this overarching constraint of getting public debt down, which means that your ability to fiddle around with the fiscal deficit, let it slip, etc., is limited. So given that you could sort of lend support to the economy, call it pump priming or whatever you will, to a limited extent. So what it did was it sort of identified different possibilities and thought that consumption demand, particularly consumption demand now from the urban middle class, has been weak and needs support. So it kind of focuses on that bit. Is it adequate to sort of get the economy on significantly higher growth trajectory that is needed in the long term? Perhaps not immediately. There are also kind of issues of the mass consumption base. So I mentioned that revenue expenditures have grown by 6.6%. One of the casualties of this very tight leashing of revenue expenditure has been the fact that you haven't made any increases to the transfers to the lower tiers of the income pyramid. For instance, one would expected an increase in Narega wages or an increase in support to farmers, etc. That hasn't happened. So it's clearly focused on a particular consumption segment, which has been weak and but that's the best you can do if you want to kind of stick to your fiscal targets. So it's really a toss up whether you wanted to sort of kind of go a little easy on the fiscal target and accommodate a couple of other things that would kind of help pump prime the economy, or whether the getting the fiscal target down is essential. Let me remind you that next year the pay commission is likely to kick in, so that will bring in some sort of binding constraints on how much you can sort of reduce revenue expenditure. You have to pay higher wages and salaries to government employees. So this is the last time, last opportunity where you get a relatively unconstrained opportunity to get your public debt under control.
Okay. So the government has made an estimate, as you just mentioned, that the nominal GDP growth is expected at 10.1%. So would you say that the budget actually assumes a very modest growth in GDP in the coming financial year?
Well, I mean, I think the budget has, over the last couple of years, been very conservative on its numbers, on its projections. Unlike earlier budgets where, you saw, very, very bloated projections which the government couldn't meet. So this is a bit like companies announcing a relatively tepid earnings growth and sort of outperforming it. Hopefully, this is sort of at the lowest end of the potential GDP growth range. Maybe it'll sort of come in higher and help revenues and so forth. But in this kind of uncertain world, from purely a credibility perspective, etc., it is best, I think, to kind of build in the most conservative scenario and appear to be underwhelming in certain circumstances. But I mean, the credibility kind of rests on your being able to deliver a 4.4% growth, even if you were to take the worst case scenario for economic growth at the aggregate.
So between growth and the fiscal deficit number, you would say that the markets would view credibility on the fiscal deficit number and the path that the government has taken a lot more. I mean, the markets would assign a lot more weightage to the fiscal math than the growth ambitions at this point of time,
And I
given
think
the
the growth
uncertainties which are there.
I would think that the markets were very concerned about consumption demand.
Correct.
And there's been a lot of initiative on the supply side of the economy by the government, better infrastructure, some easing of the ability to do business, but private investment hasn't responded. If you look at the global scenario today, you can't really expect much support from there. You're looking at potentially sort of a major tariff war, compression global trade. So if private investments haven't picked up, how do you kind of support it? And if you look at the standard macro model, you support consumption, and then that sets off kind of a virtuous cycle, if you like, of greater investments coming from the private sector. And I think what this could do is that it might just push at least the consumer facing companies to start adding capacity, because you sort of kind of permanently, it's not just one tax tweak, it is a pretty major overhaul of the entire income tax structure which pertains to the middle class. So I guess that's the bet, and every budget is really a bet on things going right. Things could just as well go wrong, but the finance minister keeps her fingers crossed and hopes for the best.
Uh, I want to go back to this aspect of the budget, potential for the budget to do a lot more from a revenue expenditure perspective to boost consumption and growth. So, some bit of expenditure switching was expected. Why do you think that there's been so much of reluctance to actually reach out to maybe the bottom half of, maybe even to boost rural demand, etc.? Narega
Uh,
allocations have not gone up. So, what could be the overwhelming objective? How do you see it here?
well, it's just how. I think the narrative as it has emerged is that, look, rural consumption was doing badly. It started picking up. But the real problem, and the problem for the consumer facing companies, is the deceleration in urban demand. So I think it is really a response to an emerging problem of urban consumption, which has remained tepid, but which has become worse, due to a number of factors. And I think it is a specific response. I mean, there could have been various combinations that could have been done. So this is effectively expenditure switching. If I thought the kind of tax breaks that the middle class got was much more than the markets had expected. So you could have had a combination of some more allocation to the rural areas, Narega or whatever, and you could have a smaller set of tax breaks. Um, that would have been classic and kept the capital expenditure steady, which it has done. So that would have been some kind of expenditure switching, because your revenue expenditure to GDP ratio would have, to capital expenditure ratio would have gone. Now, this is what, in the government's wisdom, is the best strategy forward. And I think it has quicker effects because, the middle class tends to spend quickly and more visibly in certain cases, and that's what the government wants to see.
I'll come to the last part of my last part of this interview. Now that RBI is due for its own monetary policy, what are your main expectations from the monetary policy? Do you think that it will start cutting interest rates from February?
Possibly. Although I think, classically, if there is a problem with your rupee, with your currency, with the rupee, then you tend to kind of hold back on interest rate cuts. What it has done, and with what it has done over the last week or so, is, was absolutely imperative. I think more than the rates, it was the availability of money that was getting to be a problem. And you had liquidity deficits which were setting new records every day. So the recent open market operation, the swap, etc., has effectively infused more money into the system. I think if you ask a banker whether it was a rate cut that was bothering him or the availability of cash or liquidity, I think it would be the latter that he would kind of emphasize, and that the RBI has addressed. But given now that the RBI has done, kind of loosened its purse strings, one could, with a reasonable degree of confidence, expect that it would follow through with a rate cut. The only niggle, the only thing that one would fret over is what the consequences for the rupee would be, because the textbook tells you that if your currency is under pressure, do not cut rates.
Okay. So, talking about the rupee, where do you see the rupee level over the next few months? Do you think the pressure would continue to be on the rupee, or after the budget and the policy, do you think that there is some sense of stability which could come in,
So look, the rupee,
given that the government is following a very strongly following a fiscal the path that it has indicated earlier?
right. The government has signaled fiscal stability, etc. So I think let's just look at the cause for rupee depreciation, and this has been pointed out by many analysts. It's really the dollar appreciation, the very high dollar appreciation that we've seen over the last couple of months, sort of the so-called Trump trade. Now, at some point, maybe once all the uncertainty, the tariff business, and whatever else that is being done in the US, uh, and all the appointments going through, etc., there could be some calm coming after the storm, and that could sort of take the dollar, at least stabilize the dollar, and take the dollar down a little. The dollar has its own problems. They are running, a fiscal gap which is much higher than ours. And usually, historically, the dollar, after gaining, has been punished for that. So I'm not going to say that the rupee is going to sort of keep falling, continuously. I think it will be a period of volatility. Perhaps some more depreciation is on the cards, but going forward, I expect some stability, maybe at the 86 kind of 86 half handle to come in once the uncertainty. I think there is a lot of risk off, as we go say it in the markets. Once the risk off goes away, and that's really a function of what's happening in US policy and governance. And once the risk off kind of goes away, then we will perhaps see a period of maybe reversal, or at least stickiness for the rupee for some time.
So at this point of time, do you think the RBI will keep letting the rupee find its correct market level?
Well, the RBI has been, yeah, yes, I think there has been a change in the approach to managing the rupee, and to a certain extent, it will. But I think they are still intervening and clearly not allowing a runaway move. So that will continue, and the rupee is still overvalued. But maybe we can live with a little bit of overvaluation, because if you let the rupee uh, keep sliding, then there are problems with capital flows. We just think of competitiveness and etc. But there is the other part of your balance of payments, which is the capital account. That gets hurt if you allow your currency to depreciate too much.
Abheek Barua, thank you very much for your time.
My pleasure.